Within a matter of trading hours, more than 1.8 billion ounces of silver changed hands in the derivatives market, an amount equivalent to over 2 years of total global mine production. The immediate outcome was a 40% collapse in paper silver prices. Yet on that same day, physical silver at major distributors was completely sold out, with demand increasing by approximately 250%. If one looks only at price, one is standing in the wrong place within this picture. The relevant question is not whether silver is weak or strong, but rather who is being compelled to act, and who retains the composure and the capacity not to sell. Pause briefly and situate yourself precisely at the moment these events unfolded, not on a chart, but within the actual flow of the market itself. Before the trading session had even concluded, silver price screens were continuously flashing red, updating tick by tick, as hundreds of thousands of contracts were executed at a pace beyond direct human perception. In just a few short hours, the notional volume of paper silver traded matched more than 2 full years of global production. There were no emergency announcements, no sudden geopolitical shocks, only a selling force sufficiently large to break through every familiar technical threshold. At that moment, if price alone was your reference point, the signal appeared unambiguous. The market was fleeing. Yet simultaneously, in a different arena, thousands of kilometers removed from the trading floor, an entirely opposite dynamic was taking shape. Physical silver distributors reported a sharp surge in orders, rapidly depleting inventories, and delivery schedules being pushed back day by day. These two realities coexisted in the same moment in time, yet they did not converge on a single chart. This is precisely the juncture at which the majority of market participants lose synchronization. Market convention has conditioned us to treat price as the primary and often sole carrier of information. When prices fall sharply, the instinctive response is to search for reasons to sell or to withdraw. But in this instance, the silver market was not operating on instinct. It was operating on structure. And that structure becomes visible only when one clearly distinguishes between the paper market and the physical market. At the paper level, events unfold with speed and detachment. Positions are established at scale, driving prices lower, then unwound before delivery obligations ever become binding. This process generates the impression of abundant supply, of a metal for which there is no longer demand. Yet this impression is a byproduct of short-term capital flows and leverage, not of metal physically available in inventory. By contrast, the physical market moves to an entirely different rhythm. There are no constantly updating price screens, only practical questions. Is the metal available? When can it be delivered? Under what terms? When delivery lead times extend by several weeks, this is not a psychological artifact. It is a physical constraint. Metal cannot be produced more quickly simply because paper prices decline. It is precisely this opposition that creates the particular tension in the narrative. One signal asserts that silver is weakening. The other behaves as though silver is becoming increasingly difficult to access. In the space between these two signals, market participants are forced to choose, to place their trust in quoted prices or in the flow of physical goods. Here emerges a perspective that is characteristic of this channel. Do not ask what price is saying. Ask whom the system is forcing to act. In the recent collapse, who lacked optionality? Those holding leveraged positions, subject to margin requirements, compelled to liquidate as prices moved against them. And who retained the ability to remain inactive? Those holding physical metal without immediate liquidity needs, not required to respond to every incremental price movement. This dynamic is often mischaracterized as a matter of right versus wrong. In reality, it is a matter of time horizons. The paper market operates on the scale of hours and days. The physical market operates on the scale of months, quarters, and sometimes years. When these two temporal frameworks collide, sharp dislocations are not anomalies. They are structural outcomes. When viewed against the broader macroeconomic backdrop, this divergence becomes even more pronounced. The US dollar is currently supported by expectations of monetary tightening, while simultaneously global fiscal systems are experiencing mounting pressure. Rising sovereign debt levels, increasing interest burdens, and strategic spending demands are forcing governments to reassess issues of supply chain security and defensive asset allocation. Silver, occupying the dual role of precious metal and industrial input, lies directly at this intersection. Accordingly, physical demand should not be interpreted merely as a response to lower prices. It reflects a deeper concern: the accessibility of assets in an environment where the financial system itself may be subject to heightened instability. History offers numerous examples in which defensive assets were suppressed in the short term, only to assume central importance once structural constraints surfaced. Not every episode resolves identically, but the common thread is that short-term price movements frequently mislead those who focus solely on surface signals. It must be emphasized that no promises are being made about the future. No one can assert with certainty which trajectory silver will ultimately follow. However, observing how markets respond provides insight into the condition of the system itself. When prices fall sharply, while physical demand not only persists but intensifies, this constitutes a signal that must be contextualized, rather than dismissed because it conflicts with immediate sentiment. This tension is precisely what creates space for legitimate debate. Some argue that the surge in physical demand represents a temporary adjustment that will fade if macroeconomic pressure persists. Others contend that it reflects a deeper imbalance obscured by the paper market. Both interpretations have analytical grounding, and it is their simultaneous validity that makes the current environment particularly worthy of attention. If you have followed the discussion to this point, it is likely that you are not seeking a simple forecast. You are attempting to understand your position within the broader narrative. Are you reacting to volatility or observing structure? Are you following price movements or monitoring slower, more persistent constraints? These are not rhetorical flourishes. They are questions that shape how one reads the market. At this juncture, the silver narrative extends beyond silver itself. It becomes a case study in how defensive assets behave within a system under concurrent pressure from monetary policy, fiscal policy, and geopolitics. A system in which prices can adjust rapidly, while physical realities cannot. If you hold a different view, or have identified signals that much of the market is overlooking, share them. Such exchanges not only clarify the silver narrative, but deepen collective understanding of how markets function under extreme stress. So what does this mean? This is precisely why a 40% collapse in paper silver does not conclude the story. It opens a more complex chapter. When more than 2 years of production are traded within hours, while physical silver becomes less accessible, the initial question returns with greater force. Are you observing price or the system that produces price? Throughout monetary history, whenever confidence in pricing mechanisms has been tested, gold and silver have consistently functioned as the ultimate reference points for purchasing power, quietly but persistently. In the current political and economic environment, where both monetary and fiscal frameworks are under strain, the tension between paper and physical markets is not an exception. It is an indicator of transition. And this may represent only the beginning, as the precious metals sector enters a period in which delivery dynamics, supply chains, and market structure will be examined more closely. How do you assess the impact of this divergence on the roles of silver and gold in the years ahead? Will price continue to dominate perception, or will physical reality assert itself more clearly? Share your perspective. This is Money Cycles, where we examine the structures behind major market movements. Precision in forecasting is secondary. What matters is understanding where you stand as the system itself evolves.